Hello everybody, in this video we'll be beginning with the chapter number 28, options of CMT level 1. Before watching this video, make sure to check the previous videos. In case you haven't, then I've linked it in the description box below. So you must have already heard about the term FNO or futures and options. In the previous chapter we already discussed what are futures. Now we are going to discuss what are options. So the learning objectives are: explain the purpose of options market, the major terms of an option contract, describe the Greeks. So there are various Greeks in options like delta, gamma, theta, vega. So we are going to discuss the most important option Greeks, and then we will also define IV. IV is implied volatility. We will just start with the IV in this chapter. However, in the next chapter we will be discussing IV in further detail. So this also I am going to teach you directly from the Wiley's textbook itself. So what are options basically? Option contracts are agreements that give the holder the right but not the obligation to buy or sell a specific amount of an underlying security at a specified price at or until a defined time in the future. So this is what my option contracts are. And I can go on my trading view if I want to, and I can see option contracts of anything. So there are Nifty, Bank Nifty, index options, there are stock options, there are various kind of options. For example, I don't know if it's there on trading view. Let me, Reliance 3000. Okay, it's not there on the trading view platform. I'll use the internet to show you that. Just a second. Okay, so if you go on this is my sensible platform, but you can see that there are going to be various options. There are going to be various options for various strike prices. Okay, and you can see the LTP over here. Call and put are the two types of options we'll be discussing in detail, but you just need to know what an option chain is. So these are my Nifty options. The middle is giving you my strike price, and these are my call options on the left side, and these are my put options on the right side, and this is the various strike prices, and IV is also given over here, which is implied volatility, and these are the prices of one lot of the call or put option here. Okay, we will discuss everything in detail, so don't worry about that. Okay, so options are derivative instruments. Again, we have discussed this multiple times that futures and options are basically the derivative instruments only, and options are decaying in nature. There is an expiry date for options. So options, when they reach the expiry date, they decay. So there is something known as a theta or a time value. We will be discussing that in the further part. So the value of the option reduces or decays along with the time. All other things being equal, the value will decline over time until they expire. All assets depend on some definition of value, which is then modified by supply and demand, right? However, options depend on many variables, the most notable one being the strike prices and the time left. This chapter basically discusses these factors. Okay, so now why do people use options in the first place? Let's think about that. So like a person like me, let me just take my example. I trade in commodity options and stock options. Okay, I used to earlier trade in index options, but now I don't do that anymore. I only trade in commodity options like crude options and stock options. Now why can't I directly buy the futures, or why can't I directly buy the stocks instead of trading the options? Why do I do that? So if I go on my, let's say, look at this. If I go on my Reliance stock price, one stock, one share is costing me 2,482 rupees. So if I want to buy 10 of them, what will be the price? If I want to buy 10 Reliance stocks, it's going to be 10 multiplied by 2482. Okay, so my profit is going to be how much ever the 10 of them get. Now I'll show you. If I think that the price of Reliance is going to go up, I think that the price of Reliance will go up to 3000. That is my analysis. Let's just take an example. 3000 CE. CE is call option. We'll come to that. Look at this. 2000. Okay. Let's say I think that my Reliance will go to 2560. So what's the call price? 13 rupees. And how much is one lot? Okay, so Reliance call 13.30. Let me just open my Zerodha in my phone and let me check the lot price of Reliance call option. Reliance 2560 call option. So one lot is 250. One lot is 250. So 13 multiplied by 250 would be my initial investment, which is going to be 13 multiplied by 250, 3250. I am getting 250 shares for just 3000 rupees, whereas I was getting only one share in this much capital when I am trading normal stocks. So did you understand how I'm able to buy a larger quantity with using options? See, when I say you're able to buy larger quantity, that obviously also means that your losses are also going to be magnified. But that's why people use options, because the margin required is really less. So there are various benefits. The first thing is leverage. So the leverage is basically the ability to gain price exposure at a lower initial cost. The cost you are paying is less, but the quantity you are receiving is much. The second thing is a hedging position in the spot market. In the futures chapter, I had anyway explained you what hedging is. So it's the same thing here also. For a small premium, what is premium? Premium is the margin or the price which I have to pay in order to acquire the option. In order to buy the Reliance, the amount I will pay for that is known as the small premium. They will have to pay full price or deliver the full amount of assets at some point in the future, but they can choose to close out their position before that happens. So usually what do people do is that they buy option not for delivery purpose but to gain profit over it. Okay, now let's come to the options terminology. So you guys must be aware of the terminologies if you are pursuing CMT, but I'll still just explain it to you. So we have call option and a put option. Call option is when you think that the price of the option or the price of the underlying will go up. What is underlying? If I'm trading Reliance stocks or stock options, then my underlying is my Reliance stock. If I'm trading Nifty 50 options, my underlying is my Nifty 50 spot chart, right? So if I think that the underlying price is going to go up, in that case I will buy a call option. If my vision is that the underlying asset price will go down, if I think the price will go further down, then I will buy a put option. Okay, so a call option, what happens is, if I think that right now Reliance is 2000, I think the price will go to 2050. So I buy a call option and the market actually goes to 2050, I make money. The market goes down to 1900, I lose money. Okay. Second scenario, I am right now Reliance is trading at a price of 2050. I think that the price of Reliance will go down to 2000. In that case, I will buy a put option, right? Because my vision is that the price will go down. If Reliance actually goes down to 2000, I make money. But if my Reliance price goes up to 3000, I lose money. Understood how you are going to basically trade in options? Okay. So a call gives the holder the right but not the obligation to buy a defined amount of the underlying security at a certain price at a certain date. Put option. A put gives the holder the right but not the obligation to sell a defined amount of the underlying security at a certain price or by a certain date. Now what is strike price? I will show you. So if you go on your option chain of anything, like okay, here, look at this. In the middle you are given the strike price, right? This is my Reliance Industries option chain. So you can buy a call option of various strike prices. If I think the price will go up to 2380, I can buy this 134 call option. If I think price will go up to 2400, I can buy 99 call option. If I think the price will go down to 2380, I can buy put of 710 rupees. So these are the different various strike prices on which I can trade. So that is my strike price. Strike price is the price at which the holder of the option may buy or sell the underlying security. For example, a call option with a strike price of 50 gives the holder the right to buy the underlying stock at that price, no matter what the price of the stock may be at that time. Okay. So now we have something known as the out of the money, in the money and at the money contract. So now what are these? Out of the money, in the money, at the money. We also call them as OTM, ITM and ATM. Okay. We will discuss that also. For now, let me just go through the terminologies. Expiration. So as I have just mentioned earlier that options expire. There is an expiry date for options, right? So using the, just a second, yeah. So there is a date at which the option holder no longer has any rights and the option no longer has any value. Alright. Now we have premium. What is premium? Premium is the amount which you have paid to buy the option, right? So that is the amount which you have paid to buy the option. Exercise. Now the rights are which the buyer acquires under the option to either buy or sell, whatever. So that the right is known as, when you are exercising the right, when you're using the right which you have, that is known as exercise. In the money, out the money and at the money. Now let me explain what is that in simple language. Let us say currently Reliance is trading at 2000. Just an example. So currently the price is trading at 2000. So my 2000 strike price, call and put. My 2000 strike price is currently the spot price of Reliance. It is at the current spot price. So this is my ATM, at the money. Okay. So there, if you saw the option chain, you saw that there are values which are away from the spot price as well. So now I have, let's say 2100, call, put. Now 2100, what is the spot price right now? The spot price right now is just 2000. So 2100 is something which hasn't been acquired yet. It is something which might or might not happen in the future. So that is out of the money, right? It hasn't come yet. It hasn't happened yet. It is yet to happen. So call side, something which is yet to happen, right? So I am putting this at OTM. Okay. Now 1900, call put. Let's just take call. Okay. So current price is 2000. Then do you think 1900 call has already happened or not? Yeah, 1900 has already happened. So if 1900 has already happened, it is in the money because it has already happened. So the current price, the strike price, which is the closest to your spot price, that is your ATM at the money. The strike price which has already happened is going to be your ITM or in the money. The strike price which is yet to happen, that is going to be your OTM or out of the money. Okay, what we just saw was for the put side, sorry, for the call side. Now for the put side, it is going to be the opposite. Why is it going to be the opposite? Because put side is the opposite of call, right? So for put side, it is going to be the opposite. I hope you are clear with that. Okay, so let's quickly read it. In the money, a call option with a strike price below the price of the underlying, a put option with a strike price above the price of underlying. So it is the opposite for put, naturally, right? Out of the money, a call option with a strike price above the price of the underlying, a put option with a strike price below the price of the underlying. ATM is a strike price at or very close to the price of the underlying or the spot price. Now we come to a very interesting concept, which is the implied volatility. What is implied volatility? The implied volatility is the calculated expectation of future volatility. I will show you something else so you understand it better. Implied volatility. Okay. So look at this Investopedia. It's my favorite website. Implied volatility represents the expected volatility of a stock over the life of the option. So how volatile is the stock? How will the volatility be in the future? That is something which is described in implied volatility. Okay. Options writer. Now what is an option writer? Option buyer is one person, option seller is option writer. So wherever options writer is mentioned, just know that it means that they are talking about the option seller only. American style, European style. So if you see the Indian markets, in the Indian markets the options are going to have a CE, call, CE or for call option, and a PE for put option. That is because the full form of CE is call European and the full form of PE is put European. Why is it like that? Because we follow the European style of options and not the American style of options. Now what is the difference between these two? So our options, I'm talking about India, so the options can be exercised, may be exercised only at the expiration. You cannot exercise it before the expiration, right? So that is why those are the European options. Now what are American style options? American style options can basically be exercised at any time till the expiration date. So the difference between us, the European options and the American options, is that we can exercise our option or we can exercise our right only on the expiration date, whereas the American options can be exercised whenever they want to up to the expiration date. Okay. So the option prices contain an intrinsic value. What is an intrinsic value? Their original value, their intrinsic value, and the time value. We have been discussing so far that the option, as it gets close to its expiration day, it loses its value. So that value, which is based on the time, is known as the time value. Now what is the intrinsic value? The intrinsic value is the value the option would have if it were to expire now. So that is its intrinsic value, which is always there, right? So the more in the money or the ITM the option, the higher the intrinsic value. OTM options, or the options which are yet to happen, haven't happened yet, they have no intrinsic value at all. So I hope this is something you can keep in your mind, that the ITM or the in the money options which have already happened, naturally they'll have more intrinsic value, and OTM options or the out of the money options which haven't happened yet, they will have no intrinsic value. Okay. Time value is a speculative component. The longer an option has until it expires, the greater the chance that it will move into profitability. That is why a call option with a strike price of 100 has some value even if the underlying security trades at 100. If there is time left before expiration, there is still a chance that it can rally enough. Okay. Typically, options with the same strike price but expirations further in the future have higher prices than those with nearby expiration. Okay. So what do they mean by that? If you go on your option chain, again let me take Reliance options chain. Okay. Look at this. Okay. Can you see this? These are the strike prices. These are my either call option or put option, and open, high, previous, close, whatever. Active stock options. Let's just see stock options. Look at this. Okay, strike price. Now look at the expiry date. It is expiring on 29 June. So 2500 call option, which is expiring on 29 June, is costing me, it's costing me 32. Okay. Now if my expiry date is further away, if it's 27 July, in that case the same strike price is costing me 68 rupees. Did you see the difference? It is half more than, it's double the previous one. So as your expiry date is far away, the time value is going to be more. If your expiry day is nearby, then in that cases the time value is going to reduce. Using the options market, there are many reasons why an investor or trader trades options. The main reasons, as with other derivative markets, is to hedge another position or to speculate the performance of the underlying security. Now what is hedging? I have already explained hedging in the previous chapter, but again let's just read it. A hedge is like an insurance policy, so it helps to mitigate your risk. This is what I have been explaining. that it helps to basically mitigate the risk. It helps in risk management for a small fee. For example, a portfolio manager buys a large position in a company, a stock for its long-term price appreciation potential, but it is worried that the next earning report will show short-term issues. So in that cases, he can buy put options on that stock that will increase in value if the price of the stock falls. If the stock rallies instead, the option may expire worthless. But see, it is just a medium to hedge your position, to protect your risk, to protect yourself from the loss. So even if the loss happens, from the options you are still generating your money. That is hedging. And what is speculation? Speculation is basically you and I. If I think the underlying will go up, then I can buy an option and trade in it to gain money, right? So that is just speculation, which is just normal trading activities. Major components of options prices. Option quotes include open interest, bid, ask, size figures and everything. Let's see that. Okay, so let me show you this. Okay, look at this. This is Apple chart. This is my option chain of my Apple. Last sale is LTP. Time of last sale, net change. You know what the change is. Open, at what price the strike price open. Bid, you know what bid is. You know what ask is. Ask and bid. You know this. We have been discussing this. Open interest, we know what open interest is also. Tick, exchange, previous close, yesterday's close, high, low, what is the volume, when does it expire, and this is the change. This is my Apple. So these are the various things which are basically given in the option quote. Okay. Alright. So now look at this. This is again your option chain. This is my option chain of Apple again. These are my call strikes. These are my put strikes. So you can see at different bid, different ask, and you can see when it is expiring, and you can also see what is the last priced volume and everything. So this is an option chain again. I would 100% recommend you to use the NSE.com for option chains of the Indian markets. Alright, so now let's look at this. So these are the option Greeks. Now we come to a very essential thing, which is the options Greeks. So option Greeks are very much useful in your trading. So let's see what are the Greeks. The first Greek which we know is a delta. So what is delta? Delta basically measures how much an option price changes for 1 point of move in the underlying. Okay, so as your underlying moves, let's say your underlying asset moved by 10 rupees. In that case, how much is your strike price moving? That is known as the responsiveness of the change in the option price to the change in the underlying price is known as delta. Okay, then we have what is gamma. Now what is gamma? Gamma measures the rate of change in delta. It is essentially the second derivative of price. Values are highest for at the money options and smallest for those far in or out of the money. So gamma is the rate of change in delta. So let me try to explain it to you in a better manner. Gamma options Greek. Investopedia. Okay, this is not Investopedia. Okay, I'll just show it to you here. So gamma measures the rate of change of delta with respect to a move in, just a second, option Greeks Investopedia. Okay, so look at this. Here they have given you delta. Delta measures the change in an options price with result to the price in underlying. What is gamma? Gamma basically measures the rate of change of delta. Gamma measures the rate of change in delta. Since delta values are constantly changing, gamma is used to measure the rate of change. So what is the rate of change of the change in delta? That is something which is measured by gamma. Now what is theta? Theta is the time value. We have been discussing that as the time to expiration is closer, the option strikes lose, the option contracts lose their time value. So theta basically measures the impact of change in time. What is vega? Vega is something which is related to the implied volatility. So vega basically measures impact of change in volatility. Okay, vega measures the risk of changes in implied volatility, so expected volatility. While delta measures actual price changes, vega is focused on changes in expected future volatility. Higher volatility makes options more expensive since there's a greater likelihood of hitting the strike price. So these are my 4 important strike price option Greeks. Now rho is also something, is a Greek, it's an option Greek, but rho is not used as much. Why? Because rho basically shows you how the price changes with respect to the change in interest rates. Now interest rates is something which happens in a very long term basis, right? It doesn't keep happening more often. So that is something which people usually avoid because you don't use the Greek rho. But you need to keep in mind that rho is the option Greek which basically shows you the change in price with respect to the change in interest rates. So let's quickly revise our option Greeks. Delta basically shows you the change in your option Greek as compared to the change in your stock underlying. Gamma basically measures the rate of change of delta. Vega shows the change in implied volatility. Theta is the time value and rho is interest rate. Okay. Now let's come to implied volatility. Yeah. So what is implied volatility? We just explained that, but implied volatility is the estimated volatility of a security's price and it is critical in the pricing of options. Although not guaranteed, implied volatility tends to increase while the market in the underlying security is bearish. Conversely, when the underlying security is bullish, implied volatility tends to decrease. This is due to the common belief that bear markets are riskier than bull markets. This was very self-explanatory, but I will again just explain it to you. So the moment a market is in a downtrend, the moment there is a bear market, people start panicking and people start exiting their positions. So the panic and all that, that is what is going to create your volatility in the market. So that is why IV is usually more in bear markets as compared to the bull markets. The most important concept is that IV is an estimate of the future volatility or fluctuations of a security's price. While levels of implied volatility are associated with bullish and bearish markets, it really does not predict market direction. It does not show you the market direction. IV basically just shows you how volatile the market is. It only forecasts the size of potential price swings. It shows you ki what's the volatility present in the market, right? So high volatility means a large price swing, but it could be higher or lower both. So they are saying that a big movement can come in the market. High IV just shows you that a big movement can come in the market, but it does not show you which side the movement will come. Will the movement be on the upside or downside? That is not said. See, volatility can be either ways. The volatility can also lead to a huge upward movement, but it can also lead to a huge downward movement also. So volatility doesn't show which side the movement is going to be, but it can just show you that a big movement might come. Low volatility suggests that price probably will not experience broad unpredictable change. Implied volatility is not same as historical volatility, also known as realized volatility or actual volatility. Historical volatility means past volatility or past market changes, but implied is what might happen in the future. Okay, so this symbol, whenever you see, this is signifying IV or volume. Okay, now we come to option strategies. So option strategies, again, options are extremely risky. I need to say this before ending the video, because options involve a considerable amount of risk since they are leveraged derivative instruments. So all the leveraged derivative So all the leveraged derivative instruments have a lot of risk involved in them, right? So you can start trading in options if you think that you are profitable in stocks, equities. If you are profitable in equity, then you can start with options, right? So what are pricing models? There are three common pricing models that take account interest rate, price of the underlying security, volatility, and time of expirations. So these are the things which are being used in order to decide a price for a contract or a strike price. Okay, it is very complex, but you just need to know that these are basically how they use. Now there are few pricing models. So the models which basically the Black Scholes and the Black model, the Cox-Rubinstein binomial, the Monte Carlo model. So these are the models which basically help us in pricing our option strike contracts. Black Scholes, Black model, Cox-Rubinstein binomial, and Monte Carlo model. You just need to know the name of these. These are the pricing models. Okay. Now we have warrants. Now what are warrants? Warrants are not options, but they are pretty much similar to your options only. So warrants are basically issued on stocks. They give the holder the right but not the obligation to buy shares in the underlying company by a certain date. Therefore, they are essentially call options with one difference. Call options are written by public. A warrant is written or created by the company issuing the stock. So the call options or the options, the price of the options is determined by the public, right? The price of the options is determined by the forces of supply and demand, and it is determined by you and me. But warrants, the price of warrants is decided by the underlying company itself. So warrants have longer maturities than options. When an option is exercised, one trader delivers existing shares to the other. When a warrant is exercised, the company is going to issue the new shares. So that is the difference between warrants and options. Warrants are when the company itself is issuing new shares, right? Whereas your options are when retail people like you and I, we are trading in options. What does a technical analyst need? Although they can certainly chart the prices of options over time, technical analysts do not really analyze options. What is most important is understanding implied volatility, because it is a very important concept. Chicago Board Option Exchange Volatility Index is known as VIX. We will learn about VIX index in the next chapter. So I hope you understood this chapter. Thank you.